Hey guys, and today we're going to be diving into one of the most talks about ETFs on this planet, and it's SCHD, or the Schwab USD Dividend Equity ETF. It's loved by dividend investors, debated by analysts, worshipped by passive income fans. But here's the truth: most people don't actually understand what SCHD does or what it makes it tick. So by the end of this video, hopefully you guys know exactly how SCHD works, what's inside it, how it performs, what risks it carries, and whether it deserves a place in your long-term strategy. But before you do this course, make your own research. Please make sure you have a look yourselves, because I'm not a financial investor. I'm not even an advisor myself. So, the best way to do it is do your own research, because yes, I may be right. Yes, I may be wrong. So you might as well do your own research, because I'm only going the base of my experience. So, like I say, you lose your money if you don't do your research. But let's get into it. So SHD tracks the Dow Jones US Dividend 100 Index. Now, as you can see, it's priced at $33 at the time of recording. It has a dividend yield at 3.24%. Ignore the market cap. I forgot to remove that. That is wrong. So it's because it's an ETF, so it's a fund AUM. So what has it done in the last year to date? Well, the year to date is actually up by 18.9%. Now, that's quite good for an ETF, because you want to compound your money over time, especially with dividends. Now, that is 18.9% without dividends. That's not the total return, that is price per return. So the index is built around one core idea: only hold US companies that have proven they can be reliable and pay sustainable dividends. So SCHD isn't trying to predict the next big tech winner. It isn't chasing momentum. It isn't trying to beat the market with clever tricks. It's built on rules, not opinions. And the key characteristics worth highlighting is that it's got the full replication. So SHD owns every stock in the index, so no sampling, no shortcuts. It's a quality first idea and philosophy, with companies that must pass strict tests before they're allowed into the ETF. And of course, dividend consistency. Only firms with long and stable dividend histories qualify for this ETF. So this makes SHD one of the most transparent, predictable ETFs in the dividend space. So what is the SHD's selection formula? Well, this is the heart of SHD, and the part of the investors never look at. SHD doesn't just pick high yield stocks or good dividend stocks. They pick high quality dividend payers using the multi-step screening process. So each stock must have 10 plus years of dividend payments, which filters out unstable companies, new dividends, or firms with inconsistent payout histories. Strong cash flow, so dividends come from cash. So SHD wants companies that generate real, repeatable cash, not accounting tricks. High return on equity, so measures how efficiency a company uses shareholder money. So high RO equals strong management plus business model. And high return on assets, which show how well a company uses its assets to generate profit. So SHD avoids asset-heavy, low-efficiency businesses. Financial strength versus peers. So of course, the SHD compares companies with the sector, meaning it picks the best of the best, not just good enough. And a dividend yield that makes sense. SHD avoids yield traps. Companies with high yields because their share price collapsed. This is why SHD portfolio looks different from VYM and Divi. It's not chasing yield, it's chasing quality yield. And SHD sector allocation tells you exactly what kind of investor it is built for. So each sector is by the following. So you've got healthcare at 20.67%, which is defensive, recession resilient, and stable cash flow. Consumer defensive, which is 18.75%. So think like your food, your household goods, essentials that people are going to be buying in every economy. You got the energy, which is cash-rich companies with strong dividends and pricing power. You got the technology, so it's not a high growth tech, but it's more the mature profit tech, like Texas Instruments, for example. Financials like banks and insurers with strong balance sheets. Consumer cycles, so like or clinicals with retail and spending, so it's only the strongest players. Industrial, so manufacturing, logistics, and infrastructure. Communication, which is telecom giants with stable cash flow. And pretty much 0.11% of utilities, which is almost none, because SCHD avoids low growth, high debt utility companies. And utilities isn't any of that. So, they don't do high growth, they don't have low debt, hence why they avoid it, because they have, the low growth and high debt, which actually kills most utilities. And that's why a lot of utilities actually look like they're beaten down lately, because they're not always the greatest companies that they seem like they are. So let's go into the top 10 holdings. So the top 10 holdings is 41.92% of the ETF. Now you might recognize a few. So each one is a cash flow monster. So you got like Home Depot, you got Merck, you got United Health, you got Amgen, you've got PG or Procter & Gamble, Abbott, Coca-Cola, Textile Instruments, PepsiCo, and Verizon. Now, these companies don't just survive downturns, they thrive at them. So, of course, you probably recognize those. But like both of them, it's on average 4 to 3% of the positions in the ETF. But that's quite good for those companies. Now, SCHD price performance is often misunderstood because people assume dividend ETFs grow slowly. But SCHD's long-term track record shows otherwise. A year, they've actually been up by 20.36%. 3 years, it's 32%. 5 years, 27%. And 10 years, are actually up by 127% or 126%, depending on which website you look at. But on average, they're just between 106 to 127. So this is the result of SCHD's quality streams. It avoids the weak companies that drag performance down because SCHD grows steadily, not explosively. And that's exactly what long-term investors want. But it's not just price return, it is total return. Now, of course, price return is only half the story. Total return includes dividends. And that's how SCHD shines here. So over the last year, you got SCHD that for 1 year is 24.78%, 3 years is actually up by 47.66%, 5 years 52%, and 10 years at 217%. Now, of course, over the last years, they have got other competitors. So you got like VIG, VOIM, Digro, and Divi. So they're roughly between 17 to 23% themselves. So near SHD's price and total return anyway. So of course, SHD beats every major dividend ETF in the comparison set. But that's because, like I say, SHD combines quality, yield, dividend growth, low fees, and disciplined rebalancing. It's engineered for total return, not just yield. I don't know why, but I kept seeing energy. Now, of course, dividend power. SHD's dividend profile is one of the biggest strengths. Now, of course, you've got like the yield, you've got the annual payout, you've got the 5-year CAGR, latest dividends, of course. That's what people look for. So, of course, the yield is 3.24%. The annual payout's about $1.05. The 5-year CAGR is 7.53%. And the latest dividend is at $0.2525 with 14 years of dividend growth. This combination of yield plus growth is rare. Most yield ETFs have low growth, most high growth ETFs have low yield, and the SHD gives you both. But of course, you want to make sure that the fees and costs are low. And SHD's expense ratio is 0.06%, one of the lowest in the industry. Now, of course, you've got others suggested, which is between 0.29%, 0.35%, and of course down to 0.06% themselves. Over the decades, low fees compound into thousands saves. Now, SHD keeps costs low because it's rules-based and fully replicated. No expense management. Now, of course, they also have a risk profile. Now, they do have over 101 holdings, but bear in mind the top 10 holdings is actually nearly half of the ETF. They have heavy weighted in healthcare, consumer defensive, and energy, and their turnover is about 30%. So SHD rebalances annually, which can shift holdings significantly. But of course, SHD rules keep it from drifting into risky territory, and it always returns to quality. Now, of course, SHD has competitors. Each dividend ETF has a different philosophy. So you got the VIG that is dividend growth, lower yield, VYM high yield, less focus on fundamentals, DGRO, which is growth focused, lower yield. Then you got Divi, which is high yield, high volatility. And SCHD kind of sits in the middle of all that. Quality plus yield plus discipline. That balance is why SCHD often outperforms on total return. Now, of course, SCHD's long-term appeal comes from defensive sectors, quality screens, dividend growth, low fees, and a consistent total return leadership. It's built to compound quietly, not chase hype. But in the 5 years, they've actually been beaten quite a bit by the competitors. Now, of course, there's a lot of things that you need to look into, like the risk, the high volatility. SHC slowly builds it up. It's like holding the S&P 500, but for dividends. It depends if you want the fast, quick return, or you want, the outperformance in the steady, compounding. But they can see 5 years, they're actually been beaten by all 4 competitors. But in a year, they're actually beating every single one of them. So it just shows that maybe in the short term, that steady compounding actually beats better than the high volatility stuff. Now, of course, there might be some different factors in it which I missed or haven't seen, so comment down below if you think otherwise. But I do think, even though they're actually down by like 10% off the competitors, I just think that still matters in terms of investing in SCHD, because I'd rather have that steady compounding than the higher volatility. So the long-term outlook is good. It is good for SCHD. Like I say, the dividend growth engine with 14 years of increases, the quality screens with the cash flows, they're all positioned well for high rate, low rate environments. Now, of course, there is future risk because it's got mega cap defensive names in it. But I do think that SCHD is a good one to hold. So who is it for? Well, in my ideal circumstances, it's for income investors, long-term compounders, defensive investors, people who just want simplicity, and people who prefer fundamentals over hype. Now, of course, like I say, if you want volatility, speculation, or moonshots, this isn't your ETF. But if you want viability, SCHD fits perfectly in your portfolio. Now, there is a few key watch points, in my opinion, that you need to look out for, because even long-term investors should monitor it. Now, of course, you need to monitor the quality dividends, how they're doing, are they growing? The annual rebalance, see what's happening and what's the changes. Sector shifts, see what especially they're changing, especially in healthcare and consumer defensive. The top 10 concentration, is that creeping higher? Is that changing? Who's going to the top 10? The macro trends, and of course the performance versus the competitors. These signals show how SCHD is evolving, or whether strategy remains effective. Now, of course, SCHD isn't perfect. No ETF is. But it's one of the most intelligent designed ETFs ever created. It's simple, it's disciplined, it's effective, transparent, and built for compounding. Now, of course, if you do think SCHD is the one to add in your portfolio, then of course leave a like, hit the subscribe button, comment down below if you've already invested in SCHD, and what is your opinion on it. But hopefully you guys did enjoy the video, and if you want to see more, leave a like, hit the subscribe button, and I'll see you on the next one. Goodbye.